Finance news now. Here's Rachel Pupazzoni. So, Rachel, Donald Trump has been tweeting about interest rates. What's he been saying?
Yeah, and when he tweets, the whole world takes a look, don't they, Roswell? He's saying that the Fed Reserve should be cutting interest rates by 1 percentage point and doing it sharply, saying that cutting rates over a fairly short period of time would make the US economy even better and would greatly and quickly enhance the global economy. On Twitter, the president also recommended the Fed print more money. Mr. Trump, though, also says that the US economy is not falling into a recession, but instead is doing tremendously well. To discuss this and the day's economics news, I'm joined in the studio by US economist Jim Rickards. Jim, great to have you here during your visit to Australia. Is the US economy doing tremendously well, as Donald Trump suggests?
The US economy is doing okay. I wouldn't say tremendously well by historical standards, but we're doing better than most of the major economies around the world. Germany just had a negative quarter, not a full recession, but negative quarter. UK had a negative quarter. China's slowing down precipitously, and the US economy is growing about 2.25%, which is where it's been for the last 10 years. So I would say doing okay, but okay is better than the alternative.
What's your take on what we saw last week with the bond yield curve inverted that saw equity markets wipe off billions of dollars in the US, but we've had ramifications here in Australia globally as well?
Right. Well, great question. So historically, an inverted yield curve, short rates are higher than long rates, which is the opposite of what is normally the case, has been a signal of a recession. But there's a long lag time between the two. It signals it 18 to 24 months in advance. So is this a signal of a possible recession in late 2020, early 21? Maybe, but nothing imminent. We had the Democratic presidential candidates running around on the weekend shows saying recession is here. Well, no, they have to wait about a year and a half. So it's not. And other indicators are positive. But what's interesting about this is this may not be the normal signal. And what I mean by that is, why does that happen at all? It's usually inflation's hot. The economy's strong. The Fed's raising rates to damp down inflation, so short rates go up. But investors look through that and say, well, if we have a recession because of the tightening, shorter rates should be lower. None of that's the case. We don't have inflation. There's no. That's not why the Fed was trying to raise rates before. They're trying to get ready for the next recession. So we've had so much policy intervention for 10 years. It's not clear that this inverted yield curve means what the other ones have. You have to pay attention to it, but it's not so obvious.
Donald Trump, they're talking about interest rates. Our Reserve Bank has cut interest rates here twice in quick succession. There's talk of another one by the time the calendar reaches the end of this year. Are interest rates the best way to deal with economies that are lagging?
It helps. There are other policy tools, but I was in Bretton Woods a couple of weeks ago. It was the 75th anniversary of the Bretton Woods International Monetary Conference. It was July 23rd, 1944. We were there. And we were talking about the future of the international monetary system. Very high-profile guest, Larry Summers, our former Secretary of the Treasury, et cetera. But I went in one panel, kind of off the record, so I can't mention names, but two senior Fed officials, Board of Governors level, Regional Reserve Bank, and one governor of the ECB. And I was amazed at how relaxed they were about lower rates. It makes forecasting easy when the central banks are telling you the rates are just coming down. And the reason is they've got to get real rates down. Nominal rates are low, but real rates are not that low. And it's like a cat chasing its tail. We have disinflation, so you have to keep cutting nominal rates to get to a negative real rate because inflation keeps going lower. So as usual, the president's right. They probably do have to cut. They probably will cut 1%. They don't want to, but they may have to avoid a recession.
Now, of course, the big thing that we talk about in markets globally is the trade war between the US and China. It has big impacts for us here in Australia, China being one of our biggest trading partner and US obviously a close ally. Is that a long-haul game that we're in for there?
Yes, and my reference there, and I recommend it to viewers, is in October 2018, our Vice President Mike Pence gave a speech at the Huston Institute, available online, easy to find. And what he did, he took the trade war and the currency war and put it in a much broader context with China as the main enemy, and saying, look, there are human rights issues, there are geopolitical issues, conflict in the South China Sea, and the trade wars and the currency wars and a lot else. And investors who focus on the trade wars and currency wars are important, but investors who just focus on that are missing a much bigger picture, something that looks more like Cold War II. And Australia can't dodge that bullet. I mean, I always tell investors, don't short Australia. You haven't had a recession in almost 30 years. But you are kind of joined at the hip with China. If they slow, you slow.
Now, you're in Australia for a gold national conference. Gold has been at record highs, surpassing 1,500 US. Come back a little bit in the last couple of days. But what does the future look like?
The future is very positive for gold. You have the normal vectors. You know, supply is flat, but has been for 6 years. Demand is going up. Central banks have flipped from net sellers to net buyers. That's a big deal. Kind of retail and institutional interest is higher, so that's good. Geopolitical threats, don't need to say a lot. You know, from the U.S. perspective, Iran, China, North Korea, Venezuela, Russia, you name it. So that's the vector. But the biggest driver right now is what I referred to a few minutes ago, negative real rates. Because gold, as a form of money, which is how I view it, competes with other competes with other instruments, treasury bills, et cetera. Well, if they have high yields and gold has no yield, you want the treasury bills. But if interest rates have negative yields and gold's just flat, gold looks more attractive. So that's the main driver, and that's going to continue.
Jim Rickards, great to talk to you. Thanks for coming in.
Thanks.